Welcome everyone to this breakout panel discussion, successful exits in today's environment. My name is Jeff Johnston. I'm a managing director and run mergers and acquisitions for KeyBanc Capital Markets. I'm pleased to be your moderator today. We have a great panel that I'd like to allow to introduce themselves before we get started. Ira?
Hi, I'm Ira Starr. I'm managing partner of Long Point Capital and founder of the company over 20 years ago. Time flies. And we do lower middle market buyouts.
I'm Juan Alva. I'm a partner at Pelham S2K based in Los Angeles. We're an SBIC fund that predominantly provides unitranche financing, some second lien for companies up to $15 million of EBITDA.
Dan Connolly, Managing Director and Partner at William Blair and Company, middle market focused investment bank, global and reach, but headquartered in Chicago. I co-lead our global M&A advisory effort.
Great, thanks everyone. And like I said, it's a great panel. So we've got some different perspectives across the board. So I think we'll have a really good discussion today. Just to kick off, Ira, I thought I'd start with you. The breakout session is about successful exits. What are the common attributes you've seen in the successful exits throughout your investment career?
Been doing this for about 30 years. So I'm trying to think of what's common among everything. But the exit is what we start thinking about before we buy a company. So when we invest in a company, we're really focused on what it's going to look like after 5 years and how to maximize value. We tend to buy companies that are, I would say, built for other private equity firms. We tend to build what I call resilient growing companies versus companies that are focused on a specific set of strategic buyers. So with that in mind, we're really looking at, I'd say, companies that are stable, companies that are growing, and companies that are professionally managed. So with that, stability usually means diversification. When we buy lower middle market companies, they're often have customer concentration or market concentration. And what we do is we try over the course of the 5-year period to lower that concentration, whatever it is. We owned an engineering company, which was in upstate New York when we bought it, and when we sold it. We had a company that was in upstate New York, New England, Midwest. Originally, they were focused on transportation projects, and when we sold them, they were doing transportation, water, and utility projects. So diversification was key to make it stable. We need to have a company which can prove that it can grow on a going forward basis. So if we're lucky enough, we're buying a company in a growing market. Failing that, we're buying companies that will build an M&A team internally to grow through add-on acquisitions. And in that case, we did one acquisition a year, which we could source, execute, and integrate. So we could show a new buyer that this company could keep on growing. And finally, we need a good management team in place. We're buying lower middle market companies, which I would say that are not professionally run. We bring best business practices to them. And when we leave, we've got a growing, diversified company managed by a really strong management team. So no matter what the industry is, if it's growing, stable, and professionally managed, we'll usually get a good exit. So hopefully that's helpful.
That's great. Thanks, Ira. Ira has been on the equity investing side. Juan, you're focused on it from the direct lender side. What have you seen? What can companies do to prepare for a successful financing, which is obviously a big part of having a successful exit?
Yeah, thanks, Jeff, for the question. I think it's always helpful from our perspective to have a preview of the deal that's coming, and as the incumbent lender, it's a natural question, I think, a lot of times for the sponsor to ask if we want to continue on in the investment. And, we have the history with it. A lot of times, the answer is going to be yes or no. If the answer is yes, that's great. We can help provide a staple, almost financing. We're prepared to serve as a resource for whoever is reaching out and saying, hey, what kind of financing is available? At that point, we could coordinate with the bankers, also the sell side bankers, and tell them, look, here's what we think we can do. Happy to have discussions. And even if the answer is no, and sometimes it's more important this way, to have a consistent explanation why the incumbent doesn't want to be there, I think is helpful. And sometimes the answer is as simple as, hey, this was in a previous fund. I can't, continue on in this investment. There's a consistent explanation. The sponsor has the answer. The banker knows also to tell people why the incumbent may not want to or be able to continue on in the investment. And the other scenario where I think it's helpful to have some sort of coordination is if the company has had any sort of covenant trips in its history, if it's had changes of C-level managers, and there's had to be some work between the lending group and the lenders and the sponsor and the company on helping the company get from the beginning through that difficult period and out to a successful exit. And having that type of consistent story, because a lot of times, if we don't continue on, we'll get a call from the next party, the next lender who is going to provide the financing, saying, well, what's going on? What happened? How did the sponsor deal with it? How did they manage the transition? And a lot of times, we're able to be helpful with that, be a resource and say, look, there were some difficulties, but they worked with us, and we had to, and ultimately it's led to this point where the company is now prepared for a successful exit. So I think that type of coordination, whether you want to continue on or you can't continue on, is helpful.
Okay. Thanks, Juan. Dan, from a investment banking standpoint, M&A perspective, successful exits can come about in many different ways. What changes or trends have you seen in the current market relative to pre-pandemic, or also relative to the depths of the pandemic? Dan, you're muted. There you go.
I knew I was gonna be the guy to do that. Sorry.
Has to happen every time.
I know. I'm the guy. Jeff, thanks for the question. Thanks for having me here with you today, and for you moderating. But we've definitely seen some real trends emerge in the wake of the pandemic, without a doubt. I mean, first and foremost, the one thing that we're all doing right now that we have seen that's been fully adopted is that the acceptance of both buyers and sellers to transact in a virtual world, doing it in a virtual setting. That is, I think the ubiquity of platforms like the one we're on now and other video conferencing that has been fully embraced by both buyers and sellers, and we're seeing deals get entirely done in a virtual manner. I mean, maybe there might be one meeting that between principals at one point in time, just so that people can look across the table, but the willingness for both buyers and sellers to continue to transact in this manner has been 100% accepted, and which was a good thing. A year ago, we didn't know if that was going to be the case, and we since June of last year, I would say, people adapted and were willing to transact in this format. We've also seen, as it relates to processes themselves, they have become, because we're in a virtual world, because people can't necessarily sit across the table at least as rarely as they used to. We found that the relationships driven transactions was critical. So buyers who had familiarity with targets previously, or had done some form, were able to develop a relationship to be more of a known quantity, had an advantage in processes. And because of that, the driving toward relationship being more important in a virtual setting, that actually led to a narrowing of the processes in which we've run. And so we've seen our processes get smaller and more targeted. And another corollary to that is in the environment that we're in, which continues to be transactions at extraordinarily high premium valuations, with capital readily available, both debt and equity, valuations are remained high, especially for high quality assets. And in those, you actually have to have buyers have been needing to have paths to win in order to even be willing to compete in such processes because of the expectations being so high, knowing that the only way they're going to prevail is by paying a premium price. Well, if we know we're going to have to pay a premium price, then we need to know early up front if we actually have the wherewithal to prevail. So we're seeing a higher selectivity from both strategic buyers and private equity buyers to self-select in or out early, which is also leading to a narrowing of the processes that are being run. And despite all that, we're seeing with a smaller process, we're also seeing acceleration and a shortening of the process. So not only being done with fewer parties, are being done on an accelerated time basis. So those are all the dynamics within the process itself that we've been seeing in the wake of the pandemic. But we've also been seeing is a flexibility in the form of the exits would take place, whether obviously the full sale, but we've also seen a definite increase in the amount of transactions that are resulting in shared governance between private equity firms. So 50-50 heads up transactions, that's been a significant trend. And it's been both opportunistic for both buyers and sellers in those scenarios. Usually that's kind of pulling forward a transaction and doing a 50-50 deal as opposed to waiting and doing a full deal later. And then finally, I would say we've seen a broadening of the types of buyers. I mean, there's clearly strategic buyers. Private equity remains a force, but then the emergence of SPACs has also had a pretty significant impact on our business and opening up another pool of buyers competing for assets, and also having an effect of driving up valuations even further, although creating more risk on the back end. So it's been a quite a different world, I think, than which we live in today, just 1 year out from the onset of the pandemic, but one of which we've seen a lot of significant adaptation and both buyers and sellers finding ways in which they can be opportunistic in this high valuation world.
Yeah, that's great. Thank you. I share a lot of those views of the market. We're certainly seeing the same trends. As we talk about deals in market, Ira, I wanted to come back to you, and you hinted a little bit at when you start preparing a company for exit, but when do you do that? And then really the question I have for you is, when do you know when it's time to bring it to market? How do you know?
Yeah, well, people always ask us, when are you going to sell? And we tell them. And by the way, our constituents are largely our partners in the deal, and by that I mean the management teams, because in our deals they'll own 35 to 50% of the company. They go, well, when are you going to sell us? And I go, you know what? We plan on 5 years. It's been as long as 10 years. It's been as short as 3 years. We'll all know. And it's usually when we hit sort of the predefined goals of the company. So if we know what we want the company to become when we buy it, we just sold a company literally a few weeks ago. We had tripled EBITDA over 3 years. We had planned on doing that over 5 years. It happened over 3 years. We went to the management team and said, guys, it looks like it's time. And so that is, it's pretty amorphous, but we have set goals we want to achieve. And when we've achieved them, if it takes 3 years or 6 years or 8 years, that's when we go. We usually don't look at market timing as much because it's hard to know when the market's going to be open to a deal. But whenever it is we reach an agreement with our management partners, we educate them about what this all means. In our case, they've never been through a process like this. Our deals are typically proprietary. There hasn't been a big process. And we sort of lay out for the management team exactly what's going to happen, because it's a big deal for them. And beyond that, we need to understand, do they want to roll money into a new deal, which means we're going to sell it to a private equity group, or do they just want to cash out? I would say in about 90% of the time, they like what's happened and they want to roll money in. So our target is the P universe. But we start a process over a year before we actually want to exit. And we start it by interviewing investment banks to get a sense of what do they think is important in the market. It gives us a chance to figure out who we want to use. When we reach agreement with the management team, we'll actually interview a few investment banks and pick a group and engage them, not knowing precisely when we're going to hit the market. But our goal is to be prepared to hit the market when we're ready, not to have to rush into the market. So we'll engage an investment bank. We'll do enough diligence to make sure we know the company inside out as if we were a new buyer. So we'll do all the data analytics, slicing, dicing the company. We'll do the QB. We'll do the market study. We'll do everything that anybody could ever ask about the company. We'll prepare the sim, and we'll sit there and we'll say, okay, are we ready to hit the market or not? Sometimes we wait, sometimes we don't. We exited a company a few weeks ago when we prepared the company for sale probably early last summer. We just didn't know what the pandemic was going to do to the sale environment. And so the company was prepared to go in early summer, but we really waited till, I think it was late September, to hit the market, because as everybody knows, we just didn't know what it was going to be like to sell a company in our virtual environment. So it was all ready. Once we felt comfortable, we could actually hit the market in a highly virtual mode. We hit the market. But we were ready literally 3 months before. We had to roll the QV forward. We had to update the sim, but we were set. So so again, we start day one. We're starting, how do we exit this company day one? Who is it we want to target? And bring the management team alongside of us. And in that particular deal, the management team owned half the company with us. And I think they rolled over 40% of their equity into the deal. So they're a big part of it, and bringing them along in the process is key to us. So it's all about prepare, and then hit the market, when you think the market is open to it.
Yep. No, that's great. We talked about, buying companies in the pandemic in the virtual world. You actually have experienced selling companies like in the virtual world, which is probably also a different experience.
Yeah. I mean, we sold two companies. We sold one company last October, one company a few weeks ago, and most of the interaction was just virtually. It's just remarkable. I don't know what you guys have found out. I mean, there were some in-person meetings, but most of the interaction was virtual.
It's the technology is pretty amazing that we're able to do things like this and conduct business in a virtual world. It is amazing.
Mm-hmm. People adapted.
Did. One, as you look at through your experience looking at companies, what are some of the mistakes they've made where they haven't had successful exits, where the debt financing wasn't done or wasn't successful? What are the things people should watch out for? What are the things you've seen in your career that have caused real problems in having a successful exit from the financing side?
I guess I'll couch it in I'll put it in two different time frames. One in the current environment, one what I've seen in the past. In the current environment, what we're seeing is companies that have had a change in the earnings power, and it's not reflected accurately, I think, in the materials that are or what's being presented to potential buyers and potential financing sources. And so what you'll see is companies that maybe have a lower, let's say they were doing 15 million of EBITDA before, the earnings power today is 12, but it gets presented as, hey, last year we were -2 EBITDA. However, if you give us credit for the world before the pandemic, this should be a $15 million EBITDA company and a little bit of growth. It should have been 17 million today. So that's what you should be financing going forward. Now, we're not going to ding them for something that wasn't their fault last year, being closed for a number of months. But we want a more realistic assessment of where the earnings power of the business is today. Because the worst thing you can do is get something that's presented and then find out later that, well, a lot of this is pro forma and adjustments and kind of almost a wish list of items, of add backs. The other things that I've seen in the past that are more common and just across any economic environment are sometimes one-time items that are presented as EBITDA to the buyers, the lenders go to committee and get that approved, and then when the quality of earnings come, these things get sliced and diced, and you find out that that's actually not as presented. And again, there were some one-time items built into a one-time commodity price decrease that helped EBITDA. There's a bunch of different things that come into play there, but it affects the available leverage because you'll underwrite to a lower number, and it may or may not affect the purchase price, but it certainly affects the returns to the sponsors. So it makes it a little bit difficult to adjust for those down the road rather than having more disclosure up front. And then I've seen some other things in my career that are a bit unique. We had one deal that as we got close to closing, maybe a week away, there was a delay, and I can't remember why, but it delayed out for another 4 weeks. And suddenly this is for a QSR business, and suddenly there was a spike in the labor costs. We said, what did we miss here? Is there, because we were getting weekly reports of the business, and there was a spike in the labor cost 1 week. It went into the next week. By the third week, we were concerned and saying, what's changed here? And when we dug into it, it turned out, since we had initially gotten close to the closing, the seller had ended up firing a key person in HR who managed their labor management software and optimized it for the business. And so they fired that person just to save a few bucks toward the end. And then what ended up happening is the labor cost spiked. And so it jeopardized the closing. Now, ultimately, we were able to get to the bottom of it, and we were able to close the deal. But I mean, that was penny wise, pound foolish, So I've seen a lot of mistakes like that made, but really the better full disclosure of everything. And, we've all seen a bunch of things, and we can deal with it, and whether it's, in the pandemic or prior to the pandemic. So I think, just don't hide anything, disclose everything, let people work off of, solid numbers. And I guess the takeaway from the last story is don't fire anyone to save a few bucks before the closing.
Yeah, I think that's very solid advice. Everything's going to come out at some point, and if it comes out late and it feels like it's being, it's kind of being held back, it erodes trust of that management team very quickly. So getting it out early and upfront about it, people can work through issues, but not surprises as well.
Agreed.
That's a good point, Juan. So Dan, speaking about management teams, one of your key roles as a M&A professional is preparing management teams and business owners for exits. What are some of the focus areas, or where are the spots you spend the most time on as you prepare them as they get ready to head to market?
Mm-hmm.
Hopefully for a successful exit.
Yeah, right. And well, first and foremost, I think we always start with the story itself and the positioning of the business, and what is how do we package the company in a manner in which we can present the attributes of that business such that it can drive the greatest value. And so that's, mapping the, whether that's, market position, the mission criticality, addressable market. I mean, all the work that goes into crafting the story such that it aligns with key trends in markets, hopefully big markets, so that we can sell that story to IRA to let them know that this is going to be a big play in a big market, and they're going to be the winner. So it's starting with that equity story first, and then really from there, making sure that we go through and you do all the hard work, the aligning, really the nuts and bolts metrics and KPIs that actually support that story that we're telling in the market, doing the work so that we are one that we can, really such that we can stay on offense when we actually ultimately go to market. When we drop that flag, I think it was Ira talking about preparation, and then Juan just mentioned you better let it out because they're going to hear it. Well, we need to anticipate we need to prepare so we can anticipate any and all questions such that we can stay on offense, because once we're out in the market, they don't like surprises. And as you said, you can manage through issues, particularly if we've thought about it and we can address it with data, preferably, to show that the metrics actually support the positioning such that we can drive the greatest value. And then the final piece of that is really also buyer engagement. This is, I think, becoming more important in today's market, kind of post-pandemic, than even it was going into it, because the days of a buyer getting a phone call and showing up and believing if they've never heard of a business before, that they're going to own that, buy that company, that just rarely happens in today's day and age. And in our world, Jeff, it's the equivalent of us getting a phone call on a Monday saying, "Hey, come pitch this tomorrow," a business you never heard of, and showing up and believing you're going to win. You're not, because the relationships are just that much more important, especially in a high valuation world. The opportunity cost of going and competing and what it takes to win now in a process is a upfront expense of millions of dollars of diligence before you even learn whether you win or not. So there's that sunk cost there. You got to be very certain that you're going to be able to prevail. And so having a level of buyer engagement so that you are not surprising the market and let them know that you're throwing a for sale sign out. If they don't feel like they have some connectivity to the company, some relationship, and by the way, this is true of strategic buyers as well. It's not just a private equity phenomenon. Whether it's a strategic buyer or a private equity buyer, they got to have some connectivity. The company has to be on the radar. Otherwise, if you walk into your board and you say, "We got to go pay what you know is going to be a high price in today's market for a business," and William Blair's run this process and it's going to go fast, it's going to be done in 30 days, and we got to pay this huge price. That's how you just embarrass yourself in front of your board, and you're probably gonna get fired because if it's really that important a company, we're gonna pay a high price for it. Why are we hearing about it now? We should have heard about it 2 years ago. We should have developed a relationship. We should have known the management team. We should have known timing so we could have been prepared and be ready so we can best compete. And the same is true of private equity firms. They go through the same exercise. And so that buyer engagement, knowing and reading that buyer engagement is real, such that when you do drop that flag and go to market, that process can be, your time in market can be as condensed as possible, which allows you to create the greatest degree of competitive tension from a buyer universe that's already somewhat knows the business and has a belief and a path, some level of certainty that they have an angle to prevail. That's when you drive the best outcomes. And so that all those things kind of come together in that manner. It's to have a process when you're in market that's very concise and limited, so you maximize competitive tension and drive the best price.
No, that's great feedback. So we just have a couple of minutes left. We are open to take any questions. I think Dimitri has laid out the process to do that. If anyone has questions and wants to jump in, I'll wait just a second, but maybe if anyone wants to load in there, they can do that now, or simply put it through the chat feature. Maybe while we're waiting for anything to queue up, I'll just go through and maybe ask a couple of quick closing questions of each of our panelists, just kind of 30 or 45-second responses. Ira, I'll start with you. What are you looking at? Dan mentioned earlier the high price environment today. Is that going to stay the rest of the year? Or are you going to see continuing very strong pricing throughout the year, or do you see that more stabilizing by the end of the year?
Prices are high. I don't think they're going down right now. I wish I could say otherwise. We try to compete in a different way. We say right value, right partner. We've got to be at a fair value. We're not ever going to be an outlier value, which takes us out of virtually every auction situation. But we want somebody to pick us because we're at a fair value, where sort of the cluster of the people congregate on value. And we want people to pick us because we can help them grow the equity they leave in the business, triple it or quadruple it. But I don't think in today's environment, I think prices are going to stay high. I don't see it.
Okay.
Personally, I see a booming economy, and it's going to continue going.
Yep. Juan, do you see any, I think leverage levels have, if not completely recovered, largely recovered. Do you see any headwinds throughout the course of the rest of the year in terms of availability of leverage and quantums of debt?
I think there's still plenty of availability in the market. Certainly, pricing has gotten somewhat compressed to the benefit of probably the private equity buyers. The leverage levels are back to where we were, and certainly for the best businesses out there in the market, you could argue they're even a bit higher. So I think there'll be plenty of capacity, and so long as the market is stable and you don't see, I think if you start to see a wave of defaults or problems, or covenants tripping because of inflation, and you've got suddenly commodity price increases, labor price increases that are driving down margins on the businesses in the market or in your portfolio, I think you may start to see some of that leverage pull back a little bit until we get some more certainty. But aside from that, I think it should still be a robust environment. And I would think that, there's going to be a lot of activity, especially in the fourth quarter, once there's a little bit more visibility into the capital gains and other tax increases. And people are just going to want to get out while they're under the lower tax regime.
Good comment. Do have a question, and Dan, maybe you could take this. What's the best way, in your opinion, to develop a relationship from a cold starting point? Calls, emails, networking events? What's the best way to get in the position where you can win?
Is that from a buyer's perspective or a seller's perspective? There's probably maybe you answer it the same way, but I think intermediaries can help, like investment banks can make kind of connections. Not sorry for the shameless plug, but that's certainly one way of doing it. As a company looking to access buyers, the buyers actually do a pretty good job of having young kids working phones, trying to make connection points. So especially from a private equity perspective, they do a good job of finding businesses, and utilizing your networking. That's what intermediaries are for. They're trying to make those connections, and they do that work for free. And so I think aligning with some kind of financial advisor who's deep in a sector, whether from a buyer or a seller's perspective, they're there to make those connections, and that's probably the most direct way of doing it, as opposed to, and they can tell you what marketing events, what conferences to go to. But that'd be my starting point.
Yeah, no, that makes sense. And I think with that, we're a couple minutes over. We'll have to close this. I'd like to thank all the panelists today for the great feedback and everyone's participation on the call today. I think a lot of good commentary on how to have a successful exit, and maybe one of the best ones is to, if you're running a business, run your business as if you're not trying to exit. Run it like you're running it for the long term. That's great leverage in the marketplace, and great perspective to have in terms of once you're out in the marketplace. So it's a great M&A environment. So glad everyone was able to join. Thank you, Ira, Juan, and Dan for joining, and I hope everyone enjoys the balance of the conference and has a great day. Thank you very much.
Thanks, Jeff.
Thanks, everybody.
Thanks.
Hopefully it was helpful. Bye-bye.